Alrighty. Hello, this is Jake with Cracking the Safe, the NMLS test. This video is going to go over mortgage industry history, where it started and where we are now. Okay. So at this point, if you haven't taken your 20-hour course, I've said it before, and they are not a sponsor. I'm not getting paid to say this. But the best out of the almost 13 years that I have done this, the best course to take is called On-Course Learning 20-Hour Comprehensive Safe Pre-Licensing Exam. Go online, purchase it. I think it's $250, but that $250 is well worth the investment. On top of the 20-hour course, you do get a subsystem that you can open after you've completed your 20 hours. And you can go in there. They create games for you with the information that you learn. They will create short quizzes over specific categories. They will give you a timed test, as many as you want to take. And it will show out of these 120 questions that you took within that 3 hour and 15 minutes, you got an 89. And the tests are lifelike. They take the same percentage of questions that the SAFE claims that they produce. And so the information is good. My recommendation is take your 20-hour and use the hell out of that subsystem, the on-course learning subsystem. It's one of the best things I've ever seen in the industry, and I stand by it. So let's talk about mortgage history, okay? Oh, where do we begin? I'm going to go through a timeline of different administrations and agencies that were created and when they were created. And what I want, and I'll try to flag and remember to flag to tell you to go ahead and make notes on it. But here we go. The first one that you need to make a note on, just for knowledge sake, 1862, the USDA, the United States Department of Agriculture, was created. So the USDA offers loans today, which we'll cover that later. But it was an agency that the government put out because back then, land was desolate. We had a lot of people had farms. They had a lot of acreage. The USDA back then was created to offer banks guarantees on loans through USDA required loan approval qualifications, so that if that loan ever failed, the USDA would pay that bank the amount of money that they lost. Okay, so 1862, the USDA is created. We're going to speed up. 1929, the Great Depression. You need to make a note of that. The Great Depression was what happened to Wall Street when the stock markets crashed and the banks closed. The banks literally ran out of money the day the stock market crashed because people were out in droves. So they closed their banks. We had a deep economic depression. There was no businesses. Businesses had closed, and people were very poor. We had people that were homeless, starving in the streets. It was chaos. It was terrible. 1929, the Great Depression. Next one, take a note. 1933. FDR, Franklin Delano Roosevelt, the President of the United States, came out with an act called the New Deal. The New Deal did a lot of things for Americans to get them back to work. The government invested its tax dollars into building highways, bridges, dams, things like that. So it really put people back to work, earning money, and doing a service for the government by creating some of the things that we use even today. One of the things that it created was the FDIC, the Federal Depository, the Federal Deposit, the FDIC. You look it up. I forgot the information, but it created the FDIC, Federal Deposit Insurance Corporation. Yes, Federal Deposit Insurance Corporation. Banks were very skittish about lending money. If you didn't have money in the bank, they weren't lending you money. If you didn't have an incredible amount of assets, the bank would not talk to you. Okay? People didn't have a lot of money in the bank. So to encourage the public to start trusting the banking system again and to ensure banks, not insure, but ensure banks that they would be covered in the event of something terrible happening, the FDIC was created. What the FDIC provides to this day, each account holder at your bank, or at your bank, any bank, if you deposit money into that bank via a checking or a savings account, that account is guaranteed up to $250,000 in the event of a robbery or something like that. Now, if you default on your car or if you overdraw your account, that insurance does not kick in for that. This is only for those situations where you have a chaotic situation like they did in 1929. People started drawing their money out and the bank had no money. So the government said, look, if we run in, because we're only 4 years away from what happened, if we run into that situation again, you, the bank, the government will insure each one of those accounts up to $250,000. So banks started moving forward with savings and checking accounts, things of that nature. And those accounts were secured with government insurance, not insurance, through the FDIC. So that's a question that comes up on the safe. What did the Great Deal create that helped banks recover from the Great Depression? Created the FDIC. Okay. So that's 1933. The Great Deal and the FDIC was created. 1934. Fannie Mae was created. Okay, so let me back up because I misspoke. Give me a second. There's a lot of F's. There's a lot of F's in the government. I said Fannie Mae. FHA, the Federal Housing Administration, was created in 1934. Sorry about that. So the FDIC was created as part of the Great Deal, the New Deal, by FDR in 1933, which encouraged banks to go ahead and open up and start doing checking accounts, savings accounts, things of that nature, because it ensured every account that was a depository account would be covered in the event of a crash like that or anything. So, 1934, FHA was created. Federal Housing Administration. One thing that FDR understood, like most wealthy people do, real estate runs 70% of our market. It runs 70% of our market. So if real estate is doing well, then the country is doing well. So it's things like that that you have to really pay attention to. When a market's sinking, if you have a bad real estate market, it means your economy is going to go down. Why is that? New homes create opportunities for people to make money. Developers look for vacant land. They sell money to an individual to buy the land, who's going to put that money in a bank, maybe buy a new house, maybe reinvest it somewhere. They're going to go out and buy things with that money. On top of that, that developer goes in and creates jobs to build the homes. Electricians, plumbers, construction workers, roofers, concrete companies. Everything gets done through real estate. Real estate makes 70% of the market turn. That's just the way it is. What FDR understood was that if you have a market that has a strong real estate boom, the economy will fix itself. So what FHA did, much like USDA did back in 1862, FHA came out with its own quote-unquote program. Now, FHA does not lend money. If you've already taken your 20-hour course, or if you haven't yet, one thing that you may have misunderstood is that Fannie Mae, Freddie Mac, FHA, VA, and USDA, they do loans. They don't actually give the money for the loans. We'll talk about each one of them here in a second. But just like USDA, when a mortgage was done through USDA way back then, because things have changed now how that program works, USDA told the bank, here's our guidelines. As long as your borrower qualifies based on these rules for this program, if that loan ever fails, we will guarantee, that is the term that they use specifically, USDA will guarantee the loan. What that told the lender was, if I lend Mr. Jones $150,000 on this 200-acre farm, because back then it was farms, it's not that way now, but if I lend him this money and he forfeits, or if he goes into foreclosure and loses it, it's a USDA loan. All I do is I send proof of the debt to USDA, and they will pay me, the bank, the remainder of the money on that loan so I don't lose anything. So what they did was they created FHA. So FHA comes out with a program for banks to use to qualify people to buy a home. Standard, you have to make your debt load can't be past this amount based on your income. We're going to lend a certain percentage of the value of the home. And credit, well, back then they didn't have a credit score, but your credit history had to be a certain amount. Show proof of certain debts that you've paid off and you were on time and all this stuff. So what happened is they told banks, look, if you will use our FHA program for residential homes and you qualify your customers based on this program, we will offer you insurance in the event that that customer or that borrower defaults. We will reimburse you the amount of money that's left on that mortgage. So what this does to the bankers is they're worried about lending money to anybody. They didn't want people at all borrowing from them unless they had substantial assets and ability to repay. But now you have the government saying, look, we have certain qualifying credentials that these borrowers have to meet. They're lower than what you're looking for, but it's going to help a lot more people. And in the event that that doesn't work, that customer goes into foreclosure, our insurance will pay you for your debt, the debt that's owed on that house. So banks are looking, weighing the options. It's a win-win. I can lend this person money. I can get back the loan plus interest. And if they don't pay me, the government's going to pay me the rest of the money that's owed on it. How can I lose? So hence, FHA was created again, 1934. You had a housing boom. People were buying houses, building houses, doing everything. And banks were okay with it. Banks were comfortable with it. They controlled the money. They controlled the money. So if a bank's okay with lending you money, great. The bank's getting interest. The customer's getting the home that they want to purchase. Person's working, paying their bills. Life is happy, right? So, again, 1934, FHA was created. Fast forward, 1938. 1938, 1938. At this point, we have a hotbed of activity because FHA has kicked in. The New Deal started booming with jobs. People were making money. Banks now open checking accounts and savings accounts for those people. And back then, they were probably doing side loans for them, so personal loans, car loans, whatever. 1934, a year after the Great Deal, the New Deal, FHA is created, which created an opportunity for the lender to feel comfortable lending money to a person to buy a home. So you have people employed. Now you have a booming real estate market. Here's what the government didn't expect. Banks really no longer looked at their own portfolio loans, which means they had their own guidelines to qualify people with, because why would we go out on a limb, lend money to somebody based on our guidelines, and then have to go through a fight if the home is foreclosed? We would lose, and then we'd lose money selling the house to get back what's owed on it. So banks were doing great real estate business. And then they turn around, and now FHA insurance books, because every time an FHA loan was created, that loan information was passed to the government to put in their books. So John Jones borrowed $400,000 on 123 Main Street in Phoenix, Arizona, on this date, with a copy of the debt, the mortgage. Here's the mortgage. They put it on their books. Well, business was doing so great for banks, but here's what happened. FHA loans have two different insurances on them. Two different ones. They have an annual MIP, mortgage insurance premium. I want you to write that down. You will see it as annual mortgage insurance premium. Really, it's a monthly mortgage insurance premium. It's a portion of insurance paid directly to FHA to put into their vault, so that if Mr. Jones's property forecloses, they can go to the vault, take the rest of the money that's owed on that, and pay that bank the money. So the borrower is paying this insurance through their loan. There's also what I call a one-time use fee, which is called the UFMIP, the Upfront Mortgage Insurance Premium. So that is tacked on to the loan amount in the beginning. It's a one-time pay that the borrower agrees to pay through their loan, add the loan balance to FHA. So FHA is looking at its books. So here we are. We're 4 years after the creation of FHA. And they're looking at their books and they're saying, holy crap. We have people out here with a ton of loans. And we don't even have near enough in our insurance accounts, in our vault, to cover 10%, let alone 50% of those loans if we have another meltdown, another depression. Again, they're having depression anxiety because the depression at this point is now less than 10 years before, and the economy is just now starting to spike. It's starting to go up, so everyone was scared. So FHA says, we need to find another way to get some of these loans off of our books. Because if we have another catastrophe, the government is going to have to file bankruptcy. We won't be able to pay the banks their money. So 1938 comes along, and the government goes in with Fannie Mae. Some of you have heard that name before. FNMA is how it may show up on your tests. It may say Fannie Mae. I don't know. Again, they can twist the words around. But it's key to remember, Fannie Mae was created in 1938. So what does that mean for Fannie Mae? Well, the government said, all right, look, we need the banks to stop doing all these FHA loans because we have a ton right here and our books are overloaded based on the amount of money that we actually have in here. We couldn't possibly cover even a small portion of the amount of loans on here. We need to find a way to get the bank to have money put back into it. Because banks were lending money hand over fist via FHA. And so I want you to think behind me. There's a big vault of money, right? Let's pretend I'm Scrooge McDuck. Big vault of money, stacks of bills, right? Stacks of $100 bills all over the place. In those 4 years from FHA, the bank is totally gassed with, oh, we got this insurance. The government's got us covered if these loans fail. So let's just lend as many as we can based on their guidelines. Let's lend. So think about all the money over 4 years in my vault getting extremely low. I look back, I've done 10,000 loans. And I look back and now I see a few dollar bills just getting pushed around by a breeze because it's almost empty. The bank needed to get money back in because these are slow drips and drabs coming back into the bank from the people that borrowed, right? We took out $200,000 in cash and gave it to this person. In 4 years, they've only paid us back $7,000 in principal. We need to get our money. On top of that, FHA's books are overloaded, so if anything does happen, they're screwed because they don't have enough insurance in their accounts to cover even a fraction of the amount of FHA loans that were done. So the government in 1938 created Fannie Mae. What is Fannie Mae's purpose? Well, Fannie Mae buys mortgages. The sole purpose of Fannie Mae is to purchase mortgages that have already been done from banks. That's their sole purpose. That's it. How does this work, Jake? Well, Fannie Mae comes out with its own guidelines, just like USDA, just like FHA. Fannie Mae says to the lenders, if you will underwrite these loans based on our criteria and you fund them, we promise you that as long as we've already approved the loan for you to do based on our guidelines, keep what I just said in mind, we will purchase that loan from you so you get your money back and we take it in for long-term investment. So Fannie Mae started, so Fannie Mae said, if you take new people, base them on our guidelines, we promise you, if it beats our guidelines, we will purchase it from you. So the bank hands Mr. Smith $400,000 for a house. He has him qualified for the Fannie Mae loan. As soon as that loan closes and Mr. Smith gets his money, the bank turns around and calls Fannie Mae and says, hey, you remember that deal we had? Here's one for you. Fannie Mae hands back the money to the bank, plus a little tip. They take it, and it goes into their inventory, and now they will get a different bank, or possibly the same bank. They will get a bank to service the loan, because Fannie Mae, you can't call Fannie Mae about your loan. There is a bank servicing your loan, and for those of you that have had mortgages, this may sound familiar. You started a loan with Bank of America 5 years ago. A year or two in, your FHA loan or your conventional loan got sold to another bank. We'll talk about that process, but that's essentially what Fannie Mae is doing. Fannie Mae buys bundles of loans or mortgages from banks. This is a key word to remember. A bundle of mortgages is called a mortgage-backed security. Mortgage-backed security. Mortgage-backed security. What that means, over time, as I said, in my case, big vaults of money all of a sudden went down really low. I was running out of money, right? 1934, did a bunch of FHA loans. I was only getting drips and drabs back in from the payments. I needed more money in my bank. So Fannie Mae was created in 1938 to purchase loans from banks. So what happened, Fannie Mae will purchase an FHA, VA, or a USDA loan or a Freddie Mac loan, as long as it meets that program's guidelines. So Fannie Mae reached out to the banks and they said, hey, we're a new company. Here's how things work. The government has told us to go ahead and buy some of these mortgages that you have on your books to give you your money, and we'll take ownership of them. And in some cases, better yet, we'll take ownership and you just keep taking the payments for us. Or we're going to take ownership and we'll get a different bank to take on the burden of servicing it. So for those of you that have had mortgages over the years, you may have had 2 or 3 different banks on the same loan you took out 20 years ago, 10 years ago, 3 years ago. It's because banks sell mortgage-backed securities to Fannie or Freddie or private investors. Bank of America will purchase mortgage-backed securities. Chase will purchase mortgage-backed securities. There are several tiny companies that will purchase mortgage-backed securities because it's a long-term investment. So they'll buy that bundle, pay the bank the money that's owed, so they're done with them. They become the new owner. Your loan doesn't change. What you signed on paper, as far as agreed payments, all that, your balance, none of that changes. It's just who you pay. That's the only thing that changes. So that was Fannie Mae's purchase. A purpose in the market was to create a way to get money back into the banking system so banks could continue to lend. They have their own program, just like FHA, just like USDA. So that was their purpose. Okay, still is their purpose. Now we're going to jump ahead. We're going to move forward to 1941. 1941. In 1941, the VA, the Department of Veterans Affairs, was created. You can call it DVA, the DVA, but on the test, it's just going to say VA, Veterans Affairs. The Department of Veterans Affairs was created in 1941. It was created through the GI Bill. You may have that on your test. Over the years, it's popped up a few times. What act created the Department of Veterans Affairs? The GI Bill of 1941. The GI Bill called for soldiers that were active or were active, that are active or were active, to have the opportunity to get a VA loan for a home purchase. The VA loan, as a lender, I was very proud of the VA loan itself. The VA loan is one of those products that when a veteran is using it, you just thank them for their service. They put their lives on the line to go fight battles that aren't theirs across the seas. And they signed up to protect us. That's a great deed, and it's a great loan for the veteran. And it did a lot of other stuff. The GI education bill set up the medical benefits and things. But we're talking about mortgages, so let's talk about that. What did the VA loan offer? It offered 100% purchase price of a home for the veteran. Now, one thing that the VA loan has that is expensive, but it's rolled into the loan. When I say rolled into the loan, it becomes part of their loan amount. So, for example, they buy a $100,000 house. The VA loan has what's called a funding fee. They only have one. I'm going to use the term insurance loosely because I don't want you to remember that, but it's just like FHA's upfront mortgage insurance. It's a one-time use fee called the funding fee. And what it does is it tells the bank, our funding fee is a guarantee. I want you to remember that. VA and USDA guarantee their loans. FHA insures their loans to the banks. But it tells the lender, look, here's our guidelines for qualifying. If you qualify an individual based on these criteria, and they're a veteran and proof of having veteran status, we guarantee that we will reimburse you. Not 100% of the loan. Not 100% of the loan. The most important number you need to remember, 25% of the loan amount. So when a bank does a VA loan, they're only guaranteed a quarter of the remaining balance on a foreclosure. But banks do it because it's the right thing to do. The right thing to do, in my opinion, is to give a soldier a house, period. But the VA loan is the next best thing because there's no out-of-pocket expense. There's no out-of-pocket down payments or anything like that, like there is with FHA or Fannie Mae. It's 100%. The funding fee, there's two different numbers you need to remember here. If the veteran is using their VA loan for the first time ever, the funding fee is 2.15% of the loan amount. 2.15%. If they've used their VA benefit before and that loan is paid off through sale or just paid off in general, sale of the home or in general, if they've used their VA benefit before, the funding fee is 3.3%. Those are two numbers you need to remember. I guarantee both will probably show up on your test as a question. What is the funding fee for a first-time VA applicant? What is the funding fee for a returning VA applicant, someone who's used their loan before? Those come up. Those are standard questions. So it's important to know that. How much is the guarantee to the bank on a VA loan? 25%. That's it. There's no monthly insurance like FHA, no monthly mortgage insurance or anything. And it's key to remember the difference between guarantee and insurance. And here's a mind connector. Make a note of this. I have a very common mind when it comes to information. I try to link it, try to remember funny way to remember it. Here's how I want you to remember. Think of USDA and VA. Think of USDA as a cowboy and think of VA as a soldier. Here's how I remembered it. If you piss off a cowboy or a soldier, you're guaranteed, because they both guarantee, right, to get your ass kicked. When you go to the hospital, you can use your FHA insurance to cover your medical bills. That's how I remember just the terminology. That's how key those words are. So USDA guarantees, VA guarantees, FHA insures. What does Fannie Mae do? Fannie Mae requires PMI, private mortgage insurance. They don't guarantee and they don't self-insure any loan. What they say is if certain qualifying things match and the loan to value is above a certain amount, then you have to have the borrower carry PMI until the loan hits a certain spot. And then it can be taken off. So again, VA 1941 has a one-time use fee, which is called the funding fee. Now, here's the thing. If you get on that test and you see guarantee fee, that belongs to USDA. Upfront guarantee fee and a monthly guarantee fee on their loans. The VA specifically is called funding fee. So 1941, you now have USDA doing their thing. Then we don't talk much about them because they're not widely used. FHA is offering insurance on the loans qualified through them. Fannie Mae offers either no PMI based on loan to value or PMI, but there's also another loan that's out there that they agree to purchase so the banks get back their money. And then you have VA that guarantees their loans. They don't loan the money, but they tell the lender, if you do a VA loan based on these qualifications, we guarantee we will pay you 25% of the balance. Okay. Okay. So now we're going to fast forward from 1938 to 1968. Now, these questions, you may or may not see any on Ginnie Mae, GNMA, the Government National Mortgage Association. This is another agency of the government, Ginnie Mae. Ginnie Mae does not offer any loans. She doesn't have any programs. Ginnie Mae acts as the government bookkeeping agency for FHA, VA, and USDA. So FHA and VA found that they were having to keep up with those books. Remember, I told you that the information about each loan that was under the insurance or the guarantee was sent to the agencies, and they had to keep books on all these names and addresses and these loans. So the government stepped in and said, we're going to create an agency to oversee all the bookkeeping for you guys. That way you don't have to worry about it. So GNMA, she is not a member of the primary market. Primary market is the banks. She is a member of the secondary market. Now, when 2007, 2008 hit, Ginnie, Ginnie, G-I-N-N-I-E is how they say it, Ginnie Mae. Ginnie was not like Fannie Mae. She was not intended to purchase loans from banks. But when everything hit the fan in 2007, 2008, Ginnie Mae was instructed to purchase mortgage-backed securities from banks that were failing. She was told to go in and purchase mortgage-backed security. Well, let me put it this way. She didn't know they were failing. That was the problem. We'll get into that later. But she was told to go ahead and buy some of these mortgage-backed securities. But her primary job is cutting the checks for FHA insurance to banks for loans that were foreclosed, or the USDA or VA that were guarantees. She cuts the guarantee checks and she sends it off to the bank so they get their money. That's 1968. Ginnie Mae was created. Okay? So make a note of that. We're going to move on now to 1970, the decade that nobody remembered. Everything was hooting and hollering. People, we were in Vietnam, we were getting out of it. Still had political issues and things here at home. But 1970, the government looked at its books. So it looked at FHA, VA, Fannie Mae. What stood out to them was Fannie Mae over time had purchased a lot of mortgage-backed securities. She had a lot of loans on her books, and people were using her program. So banks were using them to qualify and then immediately sell the money, so they get their money back. So 1970 comes along. FHLMC was created, which is better known today as Freddie Mac. Federal Home Loan Mortgage Corporation. Freddie Mac's intended use was to be a direct competitor with Fannie Mae, to kind of take some of the debt that she owned some of those loans where she needed to get more money in. The government created FHLMC, and it also proposed its own qualifying list to banks and said, look, Fannie, Freddie, FHA, they're cool. If you want to use them, that's fine. But here's what we do, and here's what we offer. So if you want to use our program and you fund your own loan, we will purchase it either immediately or at a later date through mortgage-backed securities, along with any other of the other loans that you've done through FHA, VA, USDA, or Fannie Mae. Just bring them on board. So now banks had the opportunity to have the big five. You had Fannie, Freddie, FHA, VA, USDA. Those are the five. So, wow. You had a big variety. Fannie Mae was a little more stickler with their policy as far as pre-qualifying somebody. If you went over even by 0.001 on some things with that qualifying percentage, she wouldn't take you. Freddie Mac's like, yeah, we'll probably take it. Yeah, just do it over here. We'll do it. Freddie Mac was more lenient. And even today, if a borrower, here's an example. Fannie Mae stops at 620 credit score. They don't go any lower than 620. You could have $200,000 sitting in the bank. You could have $30,000 sitting in the bank, and guess what? They don't care. We're not gonna purchase that loan. So don't ask us and don't do the loan as us because we're not taking it. Freddie Mac goes down to 580 on a credit score as long as you have tangible assets, tangible monetary assets. So what that means is you might have a 580 credit score, but you got $50,000 sitting in the bank, cash money, or you've got $1 million portfolio, or you've got a $500,000 portfolio. We'll take it because I see substantial assets where this person, if things got rough, could draw the money from the assets to pay their house note. So Freddie Mac dared to go lower on credit, and if they had more assets, the better, because they could be a little more lenient with debt to income ratios and loan to values, things of that nature. Normal credit qualifying stuff, Freddie Mac is a little more lenient on, where Fannie Mae's like, hell no, don't bring it over here. I don't want it. So it's 1970. Freddie Mac, FHLMC, was created. Now, here's where we get into the interesting stuff, and this is what irritates me the most, is talking about where we were. Okay. We're going to fast forward to 1986. I want you to write this down. It's called the Tax Reform Act. Was created or was put into law. For those of you old enough that remember Ronald Reagan, probably one of the best presidents we ever have. He was very conservative, didn't like wasting money, like saving money, pro-business. The country boomed under his leadership. Now, what he saw, and if you are anywhere from the 80s, 1980s, I was a child from 77. 1977, I was born, so the 80s was my decade as a kid. What the 80s brought was you had shows on TV like Dallas, Falcon Crest, Hotel, Dynasty. You had the soap operas were big, Young and the Restless, Bold and the Beautiful, As the World Turned, all this crap, right? And what did they project? They projected a rich lifestyle. They projected wealth. They projected home ownership and all kinds of things, these rich people, right? But that decade is really known as the decade of greed, because you had Wall Street were selling junk bonds and making a ton of profit on it. And everything was when I remember watching Saturday morning cartoons. And you might have a 2 minute section or a 3 minute section of commercials in between commercial breaks where you had maybe 3 or 4 commercials and they were all credit cards. Visa, everywhere you want to be, MasterCard, um, don't leave home without it, or something. The American Express card, don't leave home. They even had a card called the Diners Club card. Telly Savalas, one of the actors back in the 60s and 70s, he was the spokesman. Who loves you, baby? And he's got his Diners Club card, and he's going out to these fancy restaurants. People paid with plastic. So people were living outside of their paychecks. They were living outside of their means. They were putting things on credit and paying exorbitant amounts of interest on depreciating items. And it annoyed Reagan to no end because he's like, these people don't understand. You can still make money and store money and still have a great life, but own something so you have some solitude. So you have a solid foundation to build on. And what the Tax Reform Act of 1996 did was this. It says, basically, you can no longer write off credit card interest on your federal taxes. Believe it or not, credit card interest used to be tax deductible. However, you can write off mortgage interest. His goal was to have people stop using credit cards to the point of living off of credit cards and forgetting they live in an apartment and not a house. But in turn, if you buy a house, you have a bigger asset that has more interest that you can take off on your taxes. Now, all this did was revisit 1933's New Deal. The real estate market blew up. You had people trying to buy houses, trying to buy second homes, vacation homes, because it didn't state primary home, just said mortgage interest. Now, of course, everything starts at the top. So the wealthy, they immediately started buying rental properties, second homes, vacation homes. And all the while, that interest is helping reduce their bottom line on their taxes. So they were happy. Eventually, it bled down into the middle class. And even, we're going to stop there for a second. Eventually, the middle class, the working people, were able to take advantage of it because now they were making enough money. They wanted to buy a house. Now it was a tax deduction. Now is the best time to go ahead and buy it and go on about our business. So it was a great thing. But here's the problem. Banks were sitting there qualifying people and stopping at certain points. Now, I'm just going to give you an example because the credit score is barely 30 years old, believe it or not. It didn't come out until 1996 or 1998. So how did they qualify people? Well, they looked at your work history. How long have you worked at a job? How much did you make? How many accounts other than your utilities did you have, and what were the minimum monthly payments? How did you use that credit card? When you got it, did you keep it at half the limit, or did you max it out and keep it there? It looked at even your education in some cases. Did you go to college? Why was that important? Because back then, going to college meant that you probably were going to be in a profession where you were making a good amount of money. So that's how they qualified people. They really didn't have a credit score. They just kind of eyeballed it, especially one of the big things being assets. Do you have any money in the bank right now? Do you own more than one car? Do you have other real estate? So those things were taken into consideration back then. And so banks said, they set up their plan and they're like, okay, we're only lending if people have money in the bank. We're only lending if they've had more than 4 or 5 credit cards, showing a pattern of pay history and how much they borrowed on the cards, etc. How many late pays you had on your current mortgage if you were refinancing. How many late pays you had on a rental property. Things like that. So 1986, the Tax Reform Act. Now, I'm going to say 1996, 10 years later. This really isn't important, but it does set it up for what the hell happened and why you're here. 1996, 1998, what used to be Nations Bank, which is now Bank of America, came out with a mathematical algorithm where they could put a person's credit report into this algorithm, and the algorithm would search the histories that was on the credit report. It would take their income and look at it, number of years at jobs, things of that nature, and then it would spit out a score. That score, the lower it was, the higher risk that applicant was. The higher the score, the lower the risk, which ended up not only qualifying or disqualifying people, but it also really targeted how much interest are we going to charge this person, because if they're higher risk but they still qualify for the loan, we should make some money because we need to make our money on the front end from this person because they could end up defaulting. Right? That's how banks think, unfortunately. So 1996, 1998, the credit score was created. It was so successful that Bank of America used it as their standard. And then other banks followed suit. You had Wells Fargo, you had Wachovia, you had all these national banks now setting, instead of a credit history, they would put a credit score. So back in the 90s, late 90s, if you had a credit score of 660, that was usually the lowest score they would go with. Because now it became practical. It went from being theoretical to practical because it was proving what the algorithm number that came out. It proved that this person is a credit risk. They don't pay their bills. This person is always on top of it, and they pay 5 days sooner than what's necessary. So those things, they built credit, and then you had low credit for the people that didn't pay, or they may pay on time, but they have too much debt. Okay. So now banks set that standard. Nobody unless you're a 660. Here comes the Wild West. Revisited us only in the mortgage industry, though. You had national banks who answer to who? They answer to us. They answer to people that invest in that bank through stocks. They invest to people that are depositors. Banks have to maintain a clean image. They can't do anything radical or crazy. Otherwise, it's going to ruin their image, and then they could lose depositors and their bank could sink. Here comes the private lenders. Private lenders come and they start doing loans. They find out that most national banks are at 660. And there's this great system that they can use, that they can pay a service for, to use to figure out what somebody's credit score is. So we have these private lenders, and they're like, well, if they're at 660, what if we dropped ours down to 650, 640? All those people that they're throwing away that they can't or they won't give a loan to, we can offer up and say, hey, we go lower than they do. Use us. And then what we'll do is, because we're not a bank, we don't have investors, we can just turn around and charge them higher interest because they are higher risk. That became the new wave in the mortgage industry. The biggest company that did this became a giant in the mortgage industry called Countrywide Mortgages. You could practically go to them and they would sign you up. If you were a 520, they'd sign you up. It didn't matter, because they were going to charge you a crap ton of interest. And private lenders were buying MBSs, mortgage-backed securities, from each other. So if they ever needed more money, they tightened it up and they sold it to another bank. They would never sell it to Fannie or Freddie because back then they had standards. And then they got them back, and then they were 10 times worse than what they used to be. But so here's the banking game. Banks started seeing these private lenders taking 640s that they turned down, because later on what happened was the national banks seen that the private lenders were offering 650, some were offering 640. So the banks were like, okay, they've had those loans for 2 or 3 years and they haven't had a fallout. Let's lower our credit score. Let's go down to 640. And as soon as one bank did it, they all did it. And then the private lenders were like, well, imagine all the people that they're pushing out. So let's drop ours down to 600. The lowest the banks would go was 620. And that's pretty common today, 620, unless they're doing a loan they have no intention of selling to the secondary market, which would be Fannie or Freddie or another investor. So these lenders took the banks, the rejected customers, and were doing mortgages for them. Again, I'm going to speak specifically about Countrywide because there were many lenders that did this. But Countrywide became the biggest private mortgage company in the United States. And they didn't fail. They didn't have a lot of foreclosures. Here's why. Because Countrywide was holding their own investments or selling them to others, to other banks or private investors. They didn't have to answer to Fannie Mae or Freddie Mac guidelines or the government really looking at what the hell's going on over here, because it was more of a deal between the bank and the borrower should know better. And they figured, the government's like, well, they're just doing really good. The problem was, Countrywide, and keep in mind, they would still do the Fannie Mae, Freddie Mac, FHA. They still offered those loans, but they would really take on anybody that didn't meet the specific guidelines for the credit for them and put them in one of their private products. So what happened, Countrywide was looking at all these people with bad credit and poor pay histories, or maybe they had not enough credit to really get a good score because they didn't make a lot of money. Well, they started coming up with these different loans, odd loans, and I'm going to tell you some of them. So you had what was called the SISA, SISA, stated income, stated assets. What that means is you have an individual come in, tell you that they work here, or that they are maybe they're self-employed, or that they did work for a company and they had this job and they made $200,000 a year. Countrywide would say, cool, $200,000. Okay, we can do it for you. And then, I've got, as far as money in the bank, I've got like 500,000. Really? Okay, cool. That's all I needed to know. Here's your money. Countrywide didn't investigate the job. They did stated income, stated assets. What was the purpose? What was the real purpose behind doing CISA? Or a NINA? Or an interest only? Or a negative amortization loan? What was the benefit to them? Higher interest because they're higher risk. We won't say no, but you're going to pay for it. So if that person would have qualified at a 620, just going by today's rates, let's say they were a 620, if they could have been a 620 at, let's say, Bank of America, their interest rate may have been 5%, 6%. But now they're not a 620, they're a 570, and they're being put into a stated income, stated asset loan. Let's say that's 5 or 6%, now looks more like 10 or 11%. So the customer's like eager to buy the house. They're like, I'll sign whatever. So they sign it and they take the loan. Another one was called NINA, N-I-N-A. No income, no assets. If your credit score was good enough, but let's say you were a drug dealer and you couldn't verify how much money you had in the bank because you getting your money from illegal activities. That's okay. You do you, boo. But we got to charge you 12%. Oh, that's nothing. That's cool. Just let me buy my house. I'll be happy. 12%. No income, no assets, but their credit score was good. You had a negative amortization loan. You may sign a paper that says you get a 6% interest rate, but all you have to do is pay us 1% of the payment, 1% every month in interest and nothing else. So you have a person that may have a $400,000 house with a monthly payment, minimum monthly payment of negative amortization. And let's say their minimum monthly payment was $500, but the paper said they had that option to pay that, but the full payment a month was $1,500. What Countrywide would do was say, okay, yeah, we'll take that $500 that you paid. We're just going to take the $1,000 that you owe us and put it back on your loan, though. And what happens? That's interest and everything. They put that interest, and now you have interest on interest. So what happens? Normally, a mortgage shrinks over time. With negative amortization, that's called amortization. Negative amortization, it actually gets bigger and bigger until the due date comes or that negative amortization period on your contract is over, and now you have to pay principal and interest, and all of a sudden, your $400,000 loan is now $650,000, and your new payment's $4,000 a month for the remainder of the loan. But they would do these loans for 10 years like that. You may have a 30-year loan. The first 10 years can be negative AM. But after that 10 years was up, it kicked over to principal and interest for the remaining 20 years to pay off the balance. A lot of odd loans. So again, it was the Wild West. And there was no regulation because there was no fire. There was nobody, crying fire that there's something going on until all of those 10-year loans came to roost. It came time for those loans to come due. And now you have a victimized public who says, hey, they screwed me. They put me on this loan, and now I lost my house. So that's when 2007, 2008, all those fancy loans that they were doing started shaking and falling down. In 2006, this isn't really noteworthy, but here's what happened. Why Fannie and Freddie almost went under in 2006. Well, in 2007, 2008. In 2006, Fannie and Freddie, the government got greedy. They said, look at Countrywide, a private lender. They've got billions of dollars of assets, mortgages, and they haven't had a large foreclosure rate. We need to buy some of those. We want, let's invest. Let's call them up and say, hey, Fannie and Freddie, let's say, hey, why don't you sell us some mortgage-backed securities? We want some of that high interest over here because we're nickel and diamond, 5 and 6%. You guys have 10s and 12s over there. We want some of that action. So the government went against its own policy of purchasing unqualified mortgages from a private lender and put them into their portfolio. That when they purchased them, they were buying junk that they didn't even look at the loans. They just went and sent the money and said, send whatever you're going to send, but make them good. So they go and put these loans in their portfolio. And a year or two later, guess what happens? They go sour. They start falling apart. The loans are being called in because they're foreclosing. Freddie Mac, 33% of its portfolio was from Countrywide alone and Bank of America. Bank of America's loans too. Because when Fannie and Freddie reversed course and they started buying these unqualified mortgages, Bank of America, Wells Fargo, those two, they said, we want some of that action too. You have a lot of high interest loans. We want some of them. So sell them to us so we can make some money. And what happened was within a year or two, those loans fouled out and they almost collapsed. So that's why we had the bailout of 2008 from the government. They bailed out Fannie, Freddie, Bank of America, Wells Fargo, and the auto industry. The auto industry is a separate deal itself. But the economy took a dump, and now all of these fancy loans that this company over here had done, and several others, mind you, Countrywide was the biggest villain. They were falling apart. Bank of America went in and started just scooping up loans because they thought these loans were gold. But Countrywide knew in 2005 and 6 that these loans weren't going to last, and they started getting some that were foreclosing, and they started getting shaky. And that's when Bank of America swooped in. We're going to absorb them. And then when they absorbed them, guess what? They exploded. And we had to eat that as consumers. We had to bail them out of their own mess because of their own greed. So, in a nutshell, what we've covered. Oh, you can go ahead and make this note too. So, what that brought about, the meltdown, it brought us to 2008 when HERA, HERA, which is an act, was created and implemented. Now, I'm going to talk about HERA in the next video. I'll make that. And we'll talk more about why you're here and why certain things had to happen so that you have a better understanding of why we're so heavily regulated now. But this is an idea of where we came from. We came a long way, and then a group of people screwed it up. And now the government stepped in to play hero, even though they were one of the villains. They played hero and said, naughty, naughty, banking industry. You are under regulations now. We want we want your name and number. And that's when 2008 they enacted HERA, the Housing and Economic Recovery Act. So I'm going to talk about that in my next video. And so I hope this was helpful. And again, subscribe to the channel. If you have any questions or if you need personal tutoring, feel free to reach out to on Facebook to Cracking the Safe, the NMLS Safe Test, and it's got the golden vault door. That's the logo. Just go ahead and contact us, message us, and I'll be more than happy to help you answer any question that you have, or set up a personal coaching. That's up to you. But I appreciate it. I hope you guys have a great day. I'll see you in the next one.